Happy Monday, everybody. After spending much of the summer focused on inflation, interest rates, and record highs in the stock market, investors were reminded last week that all three of those issues are connected. The big story was a sharp move higher in long term interest rates, fueled in part by rising oil prices and continued tensions with Iran. That put pressure on stocks, particularly technology, and despite a nice rebound on Friday, all three major indices finished the week lower. So let's look at what happened and let's talk about what's going to happen this week. Monday started with stocks under pressure as investors once again focused on the Middle East. Oil prices moved higher as negotiations between the United States and Iran remained stalled, and the 30-year Treasury yield climbed to its highest level since 2007. Higher oil prices can add to inflation concerns, and higher bond yields can make stocks, especially expensive growth stocks, look less attractive. By the closing bell, the Dow was down a half of 1%, S&P was down about a half of 1%, and the Nasdaq was down about a quarter of 1%. Tuesday brought more of the same, but technology stocks took the brunt of the selling. Long-term government bond yields around the world moved to multi-year highs, with the U.S. 30-year Treasury reaching a 19-year high. At the same time, elevated oil prices continued to fuel inflation concerns. Semiconductor and technology stocks were particularly hit hard, and that explains why the Nasdaq substantially underperformed the Dow. For the day, the Dow was down about a quarter of 1%, S&P was down about three quarters of 1%, the Nasdaq was down 1.25%. Wednesday finally brought some relief. The Treasury Department announced that it would increase its purchase of long-term government debt, including doubling planned purchases of the certain 10 and 30-year maturities. That helped push long-term yields lower and gave stocks some breathing room after three consecutive losing sessions. Healthcare stocks also got a boost following positive news surrounding an experimental cancer vaccine, while lower yields helped parts of the consumer sector. The gains were relatively modest by the close, but they were enough to break the losing streak. The Dow finished up about a quarter percent, S&P was up about a quarter percent, and the Nasdaq was also up about a quarter percent. Unfortunately, the relief did not last. On Thursday, Treasury yields moved higher again, essentially reversing much of what Wednesday's improvement was. The 10-year Treasury climbed back above 4.7%, while the 30-year moved back above 5.2%. Oil prices also continued higher as tensions with Iran remained elevated. And there was another headwind: Walmart. The retail giant's shares dropped sharply after comparable sales and its earnings outlook disappointed investors. That was particularly painful for the Dow. By Thursday's close, the Dow was down about 1.25%, S&P down about three quarters of 1%, and the Nasdaq was down about 1%. Finally, Friday came along, brought a better finish to the week. Stocks bounced after Thursday's sell-off, with healthcare and financial stocks among the areas providing support. The Dow had the strongest performance, gaining more than 500 points. Still, Friday's rally wasn't enough to erase losses from earlier in the week. For the day, the Dow was up about 1%, S&P up about a half of 1%, the Nasdaq was up about half of 1%. But for the weekly wrap up, it was a down week across the board. The Dow lost about 1%, S&P lost about 1.5%, the Nasdaq was the weakest of the three, falling about 2.25%. And that difference is important. Technology stocks were particularly sensitive to the rise in interest rates last week. The information technology sector fell more than 3%, while energy actually gained more than 2.5% as oil prices rose. Healthcare was another bright spot, gaining more than 4% for the week. The bigger takeaway is that long-term interest rates have once again become one of the most important variables for the stock market. Economic growth remains relatively solid. Corporate earnings have generally been good. But if long-term rates remain elevated, investors may become less willing to pay high valuations for stocks, particularly in technology. Now, that brings us to the week ahead, and there's a lot to watch. Today is relatively quiet with no major economic reports scheduled. Tomorrow, we're going to get housing data, including some home prices and new home sales, along with the Conference Board's consumer confidence report. Then Wednesday is probably the biggest economic data day of the week. We'll get the Federal Reserve's preferred inflation measure. That's the PCE price index. Now, I actually heard one of the Fed heads say this on the air on CNBC last week. I thought it was just the line that the media used, but he actually said it. We'll also get personal income and spending, the second estimate of second quarter GDP, and July durable goods orders. That inflation number could be particularly important after last week's rise in bond yields. Investors will be watching closely for any evidence that inflation is continuing to cool. Wednesday is also a huge day for earnings because NVIDIA reports after the close. Given NVIDIA's size and the enormous amount of investment going into artificial intelligence and data centers, its results have implications well beyond just one company. Other major companies reporting this week, includes CrowdStrike, Salesforce, Intuit, and several retailers. Then on Thursday, we'll get weekly jobless claims and the beginning of that Jackson Hole Economic Policy Symposium. That brings us to this week's Fed heads. Barkin speaks twice tomorrow and again on Wednesday. Then on Friday, Fed Chair Warsh delivers the keynote address at Jackson Hole that has moved markets in the past. His comments could be particularly important because investors are looking for more clarity about how the Fed is balancing inflation, economic growth, and the recent rise in long-term interest rates. So as we as we head into this week, there are really three things I'm watching: inflation, interest rates, and Nvidia. The inflation continues to moderate. That could help take some pressures off bond yields. If yields begin moving lower, that could provide some support for stocks. And Nvidia's earnings will give investors another important look at whether the extraordinary level of spending surrounding artificial intelligence continues to justify some of the market's highest valuations. As always, 1 week of market volatility doesn't change the long-term financial plan. We're going to keep watching the data, separating the headlines from what actually matters, and making adjustments when the facts, rather than the emotions of the market, tell us they're necessary. Have a great week. I'll see you next Monday. Don't forget to check out the Friday planning video. Have a great week.